I am joined by Lance McGray, Managing Director, Head of ETF Product at Advisors Asset Management. Lance, thanks so much for joining us.
Thanks so much for having me.
So Lance, let's dig in. You have three key guiding principles for investors. What are they?
Yeah, I would say, thinking about 2025, going into this year, the CIO team at Advisors Asset Management has really been talking about the 3Ds. The 3Ds is really what we've been using to help financial advisors and investors sort of navigate these very challenging times that we're experiencing. The first D would be diversification. I think many folks think about diversification. They talk about traditional stocks and bonds, 60-40. We take it a little deeper. We're looking at more specifically, sectors. Where are there themes that you can capitalize on? Where should you be on the yield curve? Take it much deeper in terms of the diversification, and we can talk about that a little later in the segment. The second D is essentially dividends and income. At AAM, we really are an income shop, and I think a lot of investors are sort of finding comfort in dividend-paying stocks and actually moving out of cash and replacing it with coupons right now in 2025. And then the last one is deliberate. In this type of environment that has so much uncertainty, it's really important to be deliberate, whether it's with active managers or rules-based strategies that may have a higher active share than most beta products, but it comes down to diversification, being deliberate, and finding dividends and coupons.
So let's start with diversification then. How should investors be thinking about diversifying their portfolios right now, and what are you actually seeing in terms of how they're doing it?
Well, I think there's a few things that we want to talk about when we're talking about diversification. Let's start with the U.S. equity market, right? Many investors are investing in the Qs or the S&P 500. What we're hearing, and this has been the case for quite some time, is that there is a very high level of concentration in the top portion of those names, specifically the Mag 7. Obviously,
some of the Mag 7.
Some of the Mag 7. But overall, the performance has been fantastic. Obviously, we're reaching all-time highs based off of those few names because their weighting is so high. It could be 30 to 40% of an allocation of a traditional beta product. But that's something that investors are starting to become worried about, right? And that's one thing that we're focusing on. There's opportunities out there where you can outperform the market, the S&P 500, without taking on that 30 to 40% exposure in 7 names. For example, at AAM we have a ticker TRFM, which is the AAM Transformers ETF. We don't hold 500 names. It's a rules-based product that focuses on R&D and sales and analyst ratings. And this product has outperformed the S&P 500 with only about 7.5% Mag 7 exposure. So there are opportunities out there. We're looking at smaller mid-cap companies, those companies that really have the ability to grow, right? One thing that we always say is that the U.S. does not have a monopoly on really good ideas. And by us looking at real R&D specifically with the Transformers ETF, we're able to capture a lot of the secular trends that we're seeing in the marketplace without having that Mag 7 exposure.
What are some of the biggest holdings in your Transformers ETF if they aren't Mag 7?
Well, they are some of our largest holdings, but what happens is some of our largest holding actually only has a 1% weighting in the overall portfolio. So what you get is a product that's much more diversified, right, across the entire suite of of securities or companies that are growing, that are being transformative, that are transforming the world around us.
Okay, and then when it comes to dividends and income, one might think of those as more of the kind of the safety plays.
Absolutely, but I think most people, specifically over the last 10 years, they tend to forget historically how important dividends have really been for equity investors. For example, if you have a crystal ball and you can essentially remove yourself from those companies that cut or can stop paying their dividends, you can actually outperform the S&P 500s, going back 60 years. So yes, there is some aspect of comfort. Yes, there is some aspect of quality. But when you start reinvesting these dividends, when you start compounding those dividends over time, it can be a real driver for outperformance. And we expect the market to come back to that, right? We expect to move away from the Mag 7s and find some growth in dividends, some quality stocks going forward.
Okay, and I do want to dig into that in just a second, but just to add to that third point, being deliberate, can you give an example of how investors can be deliberate in the strategies that they choose?
Absolutely. So, for the last decade, most people have been, putting their money in the S&P 500, an index-based product, or an active manager that might be deemed a closet indexer, closet manager. At Advisors Asset Management, we believe that there is value in having an active manager that goes essentially across against the grain, if you will, and provides exposure that you won't get otherwise in traditional beta products. So it comes down to finding an active manager that has a proven track record in a specific strategy, whether it's U.S. large cap, U.S. growth, small cap. It could be in the fixed income space in a low duration aspect, or even high yield space as well. So it's really, really important in this environment to find a manager that is well proven, that has a solid track record, and can help navigate these challenging market environments.
What's your read on active versus passive ETFs? Are you finding that investors want to go beyond the index ETFs and get a bit more active in their approach?
Absolutely, and 2025 is shaping up to be sort of the pinnacle year for that. For the last 20 or so years, the majority of the assets and the majority of the products in the marketplace have really been beta products. Right, we're talking about, going back to the early 2000s, we're talking about the ETF wrapper, right, which is rather new. People didn't understand what it was. Oh, it's like a mutual fund, but it trades on an exchange. What are these market makers and liquidity providers and lead market makers, and how do we execute? And there's a primary market and a secondary market. These are all things that we are sort of growing past, if you will, and now it's coming down to the strategy. So you mentioned a great point, and just last month, we saw an interesting stat that I find still to this day very hard to believe, is that as of last month, there's more active ETFs in the marketplace than there are rules-based strategies, and that is a complete 360 change in terms of what we've seen over the last 10 to 20 years.
What does that mean for the everyday investor, though?
What that really means is it's a great thing, right? You take a very user-friendly, tax-efficient, transparent ETF wrapper, and now you're opening it up to a tremendous amount of strategies that have otherwise been in the market through other wrappers, whether it be a unit investment trust or an SMA or a mutual fund. And as you see more traditional mutual fund and asset managers enter the ETF space, it means one thing, and it means that there's a lot of optionality for shareholders, for end users of ETFs to gain the exposure that they're looking for, which is a great thing.
Okay, and you mentioned the broadening out that you're expecting to see in the market as we are in the back half of the year. I'm curious just what you're actually seeing in terms of ETF and market trends, the inflows, outflows, and where the money's going that makes you expect that broadening out, but also are you getting any signs that investors are turning cautious with the market near record highs or at record highs? Any signs that investors are too confident?
I think there's a lot in there, right? When we look at flows, and we look at, as an ETF product team, we look at flows every single day. We're looking at quarterly flows, weekly flows, year-to-date flows. And what we can see is through the first 6 months of this year, we're on pace, the ETF industry is on pace to set a new record, which seems to be happening almost every single year. One of the reasons that is because, as we mentioned, more and more managers are coming to the market with their active strategies, right? So when you think about the $32+ trillion mutual fund market, we're going to see more 351 conversions of SMAs and mutual funds, or we're going to see more clone products come into the ETF landscape. So we're going to continue to see those flows migrate from what some may say is a less superior wrapper than the ETF wrapper into the ETF itself. But outside of that, we are seeing a lot of investors starting to take pause. We're at all-time highs in the U.S. equity market. But another thing that our CIO team continues to stress is it's about time in the market, not timing the market. And a perfect example of that is when you look at forward-looking returns, when we reach new highs, believe it or not, on the 1-year basis, 3-year, 5-year basis, going forward, the forward-looking returns investing at all-time highs is actually higher than it would be if you invested at any other time. So again, it comes down to time in the market, not timing the market.
Okay, and just finally, if I'm just an everyday investor listening to this, hearing about all of these ETFs on the market, knowing that the market's at record highs, how do you help me cut through the noise and figure out where I actually really want to be investing my money?
Absolutely, and the great thing about end users or investors in the ETF wrapper itself is there is a tremendous amount of resources. For example, you can go to the AAM website, sign up for our newsletters, get a tremendous amount of content collateral, which, Cliff Corso, who heads up our CIO team, who is our president and CIO, he does a fantastic job of breaking it down, making it digestible, and making it so that investors and financial advisors can implement the strategies and the ideas that we're bringing to market. So the content is out there. Just be on the lookout for it.
All right, Lance, thanks so much. Really appreciate it.
Thanks for having me.
Great. That is Lance McGray, Managing Director, Head of ETF Product at Advisors Asset Management.